Welcome to the deep dive. We're here to sift through all that information overload and bring you, well, the insights that really matter. Today, we are diving deep into SoFi Technologies. That's ticker NASDAQ SoFi. If you follow the financial world at all, you've probably heard the buzz. This fintech giant is making some serious waves, especially with their latest Q2 2025 results, and interestingly, a pretty bold return to crypto. So, our mission today is to cut through that noise, give you a balanced, digestible analysis. We've got insights from, well, all over the Q2 financials, analyses from A Invest, The Motley Fool, earnings forecasts from MarketBeat, even a fascinating chat with SoFi co-founder Mike Cagney. We want to explore if SoFi is truly set up for long-term dominance, or maybe if the market's expectations are, getting a little ahead of things. The burning question we're tackling for you is SoFi a buy right now? Okay, let's start unpacking this. SoFi it's really evolved, hasn't it? It's not just a lender anymore. They pitch themselves as this one-stop shop for digital financial services, and it seems built around this concept they call the Financial Services Productivity Loop, or FSPL.
What exactly is that? And why is it so key to their whole strategy?
Right, the FSPL. It's actually pretty clever because it's designed to be this self-feeding growth engine. Think of it sort of like a flywheel. So OFI gets you in the door with one product, maybe a student loan, right? Then the cost to sell you other things, checking, investing, a credit card, drops significantly. The more you use, the more data they get, making it cheaper and easier to offer you even more relevant services. It basically turns their members into a growth engine. It cuts down customer acquisition costs, boosts lifetime value. It's meant to create really sticky, engaged customers.
Okay, so it's about leveraging that existing customer base. How does that actually translate into performance? How do they do in Q2 2025 across their different parts?
Yeah, you can really see it working when you break down their Q2 performance. They've got three main segments. First, there's lending. That's their foundation. Record originations in Q2, $8.8 billion total. Personal loans were up like 66%, home loans up 92% year over year. That's where they make money from interest and fees, the traditional stuff. Then you have the technology platform. This includes Galileo and Technisys. It's more of a B2B play, providing infrastructure for other fintechs, even banks. As of Q2, it was enabling 160 million accounts. And the great thing here is the revenue. It's capital light, high margin coming from SaaS fees and interchange.
So less risk, potentially higher profit margins on that side.
Exactly. And finally, the financial services segment. This one is growing the fastest. Q2 revenue more than doubled, and its contribution profit, that's kind of its segment-specific profitability, jumped an incredible 241%. This covers everything else: FDIC-insured checking and savings, SoFi Invest, credit cards, insurance. It's that whole one-stop shop vision really coming together.
Wow, okay. Doubled revenue and profit jumping 241%.
Yeah.
Pretty explosive growth in that segment.
Absolutely. And overall, Q2 2025 was just a record quarter across the board for them. Record adjusted net revenue, $858 million, up 44% from last year. Record adjusted EBITDA, that's earnings before interest, taxes, depreciation, amortization, hit $249 million, up a huge 81%. It shows that strategy is really gaining traction. They added 850,000 new members, hitting 11.7 million total, up 34%. Product growth was just as strong, 1.26 million new products, bringing the total to 17.1 million, also up 34%.
So members and products growing in lockstep, basically.
Pretty much. And importantly, their fee-based revenue surged 72% year over year to $377.5 million. A big chunk of that came from their loan platform business, originating $2.4 billion in loans for third parties. And the big headline really was achieving 7 straight quarters of GAAP profitability. Q2 net income was $97 million, diluted EPS of 0.08 cents. All this strong performance led them to raise their 2025 guidance pretty significantly. They're now projecting adjusted net revenue of $3.375 billion and GAAP EPS of $0.31 for the year.
7 consecutive quarters of GAAP profitability that's using the standard accounting rules. That is a huge milestone, especially for a growing fintech. What does that consistency really mean for SoFi's future? And, with all this rapid growth, how's their credit quality looking? Are they taking on too much risk?
Well, that consistency is key. It suggests they've built a model that's sustainable, not just chasing growth at all costs. They're showing real operational efficiency and a clear path to lasting profit. And on credit quality, the news in Q2 was actually very positive, which is reassuring. The annualized charge-off rate for personal loans actually fell to 2.83% from 3.31% the quarter before. And the 90-day delinquency rate for personal loans dropped to a really low 0.42%.
Wow, less than 0.5%.
Yeah, it's quite good. Student loan delinquencies were stable at just 13 basis points. That's 0.13%. It really points to disciplined underwriting, even while they're expanding so quickly. What's also interesting is their newer loans, the ones originated between late 2022 and Q3 2024, are showing net cumulative losses of 4.23%. That compares really well to the 5.75% they saw at the same point for loans from back in 2017, and it's well inside their own internal loss tolerance of 7-8%. So it suggests they're managing risk effectively, which, is absolutely critical if you're a lender.
Okay, let's shift gears a bit. This crypto comeback, it feels pretty significant, especially since they exited that space back in late 2023. What's really driving this pivot back into crypto, and what are the key things they're planning to roll out this time?
It seems like a very calculated strategic move. They're aiming to reclaim a niche and definitely attract those younger, tech-savvy users. The plan is to relaunch crypto trading by the end of 2025. They'll start with spot trading for Bitcoin and Ethereum, but the ambition is bigger. They're talking stablecoins, staking, even crypto-collateralized lending within the next couple of years.
So not just dipping a toe back in.
No, it seems like a deeper integration into their whole one-stop shop idea.
Hmm.
And it's worth noting the market reacted pretty positively. SoFi stock jumped over 2% on June 25th, the day they announced these plans. So there's definitely some investor optimism there.
Okay, but is it just about trading? Or is there more to the blockchain play?
Oh, much more. The potential game changer, I think, is their plan for a blockchain-powered remittance service. This is really a direct challenge to the old way of sending money internationally. Think Western Union, MoneyGram. By using blockchain, they're aiming for near-instant transfers with really transparent fees, trying to undercut those legacy players significantly.
And that market is huge, right?
Absolutely massive. The U.S. alone sends about $93 billion a year in remittances. Globally, it was over $800 billion in 2023, according to the World Bank. So picture this. An immigrant in the U.S. sending money, maybe USD or a stablecoin pegged to the dollar, to family back in Mexico City. Instead of waiting days and paying hefty conversion fees, the funds arrive in minutes. That's a huge difference.
Yeah, anyone who's done that knows the pain points. It's not just about cost, it's speed and convenience too.
Exactly. And for SoFi, it's not just a potentially profitable service, it's a gateway. Get someone using remittances, maybe they'll open a SoFi savings account, maybe use SoFi Invest. It pulls them deeper into their ecosystem.
Makes sense. But, crypto and regulation, that's always been a tricky area. You mentioned they exited before. What's changed now? Why is the timing right this time around?
That's a really important point. And the landscape has shifted quite significantly, actually, in SoFi's favor. The key thing was the Office of the Controller of the Currency, the OCC. They issued a couple of interpretive letters, 1183 and 1184, back in March and May of 2025. And these letters basically gave national banks the green light to get involved in crypto custody and stablecoin activities.
So regulatory clarity that wasn't there before.
Precisely. It removes a lot of that earlier uncertainty and fear of regulatory crackdowns. Plus, it aligns with a sort of broader trend we're seeing under the current administration, a bit more encouragement for innovation in financial services. It just makes the environment much more welcoming for banks like SoFi to step into the digital asset space.
So we've got strong financials, this bold crypto and blockchain move. But fintech is, it's an incredibly competitive space. What really gives SoFi an edge against the big banks on one side and all these nimble fintech startups on the other? Are these advantages actually sustainable?
Yeah, that's crucial. And SoFi does have what look like some pretty deep moats, some real competitive advantages. First and foremost is that national bank charter they got back in February 2022. That was a huge deal.
Why was that so significant?
Because it lets them fund their loans using low-cost member deposits instead of having to rely on expensive wholesale funding markets. In Q2 2025 alone, they estimated that saved them something like $551.9 million in annualized interest expense. That's a massive, durable cost advantage most other fintechs just don't have.
Okay, that's a big one. What else?
Then there's their Galileo platform, that B2B tech infrastructure we talked about. It has huge potential. They're starting to open it up to third-party developers. Think kind of like Twilio for communications, but for financial infrastructure. It diversifies their revenue streams, plus it lets them innovate faster and cheaper for their own products, too. They're even building AI into it, conversational AI for lending, fraud detection, hyper-personalization, tools like a cash coach.
So the tech platform is both external revenue and internal efficiency.
Exactly. And then, of course, you have to come back to the FSPL, that financial services productivity loop. It's a powerful network effect. They mentioned 35% of new products are being adopted by existing members. That dramatically lowers customer acquisition costs and boosts that all-important customer lifetime value. And you wrap all that up with their growing brand strength. The SoFi Stadium deal helps. They have about 8.5% unaided brand awareness, which is pretty solid.
It definitely sounds like they're building this tightly integrated ecosystem. Now, we talked about blockchain for remittances. How does that specific strategy fit into the, let's say, the bigger picture, the grand vision for digital assets? Especially when you hear from pioneers like SoFi co-founder Mike Cagney.
Right. Mike Cagney's perspective is really interesting here. He talks about a fundamental shift happening in capital markets. He argues that blockchain is essentially replacing trust with truth, cryptographic truth. And this enables something he calls democratized prime brokerage. The idea is basically anyone with capital can lend directly to anyone who needs it on a totally secure basis, cutting out many traditional middlemen.
So peer-to-peer at a much larger, more institutional scale.
Sort of, yeah. And his current company, Figure, has actually demonstrated this. They've used blockchain in the securitization process that's bundling loans into securities and managed to cut out over 100 basis points, over 1%, in expenses. That's real money, a tangible economic benefit.
Okay, so it's not just theoretical.
Not at all. And Cagney points out that this directly disrupts what he calls rent-seeking businesses. The established players like the Depository Trust Corporation, DTC, Intercontinental Exchange, ICE, even Visa, who profit from being those trusted intermediaries. Blockchain reduces the need for them. We're even seeing hints of traditional finance moving this way. Cagney mentioned the potential for JP Morgan to launch its own JP coin on Ethereum, maybe by Q4, once stablecoin legislation is sorted out.
Wow, JP Morgan on Ethereum, that'd be something.
It signals a real shift. The ultimate vision, as Cagney and others see it, is like an exchange of everything. Equities, bonds, crypto, all trading seamlessly, all cross-collateralized, and crucially, held in self-custody using things like multi-party computation, or MPC, wallets. These wallets split up your private key, making them super secure without relying on one central custodian.
Okay, that sounds like the future, but are we there yet? What are the hurdles?
Well, Cagney is also pragmatic. He acknowledges a key hurdle right now is transaction speed. Blockchain systems currently just can't handle the sheer volume of transactions per second. The TPS that traditional systems like NASDAQ or Visa can process. NASDAQ does, 250,000 transactions per second? Visa hits maybe 680,000. Current blockchains are nowhere near that, so that's a major bottleneck for displacing the existing financial plumbing entirely.
Okay, so we've got impressive growth, really innovative strategies, this ambitious long-term vision. But let's get to the elephant in the room for investors, the valuation. Is SoFi stock actually a good value right now at its current price? And what are the major risks people need to consider?
Right. This is where the rubber meets the road for potential investors. And you have to say, the market seems to have priced SoFi for, near perfection. The valuation is high, very high. Depending on how you calculate it, the forward price to earnings, or PE ratio, has been anywhere from 48 times earnings to over 100 times. The industry average is closer to 20.
So way above average.
Way above.
Yeah.
And its price-to-sales ratio was around 8.18x back in July. These numbers tell you the market has incredibly high expectations baked in. SoFi needs near-perfect execution, continued rapid growth, just to justify that stock price, which was $26.15 on August 27th. In fact, if you run different financial models like discounted cash flow analyses, you get a huge range for what the fair value might be. Some say as low as $7 a share, others up to $30. It just shows how sensitive the valuation is to your assumptions about future growth and interest rates.
And that high beta, 1.71, reflects higher risk too.
Exactly. It means the stock tends to be more volatile than the overall market, reflecting that perceived risk.
Okay, so high valuation is risk number one. What else should investors be watching?
Well, several things. First, just the inherent crypto volatility. If Bitcoin and Ethereum prices tank, that could definitely scare off some users from their new crypto offerings. Then there are the big macroeconomic factors. Those U.S. tariffs put in place in 2025, they could potentially slow U.S. GDP growth and push consumer prices higher. For a lender like SoFi, that's a double whammy. It could strain household budgets, maybe leading to more loan defaults.
Right, hitting their core lending business.
Precisely. And the Federal Reserve is in a tough spot, too. If they keep rates high to fight inflation, it could dampen loan demand. If they cut rates, inflation might pick back up. It's a challenging environment for any lender to navigate. Competition is also relentless, big banks aren't standing still, and you've got other sharp fintechs like Block or Coinbase vying for the same customers.
What about insider activity? Does that tell us anything?
It's an interesting point. While the CEO, Anthony Noto, has been consistently buying shares, which is usually a good sign, other executives have actually been net sellers. Records show they've sold over 34.9 million shares in the last 12 months. That kind of divergence. Well, it raises questions about how insiders view the current valuation.
Hmm, that is interesting. Any other flags?
Well, some might point to their negative free cash flow, which was around negative $2.8 billion dollars. But you have to understand their business model. As a lender that's growing fast, they invest cash up front to originate loans, hoping to earn interest over time. So a negative FCF isn't necessarily alarming for them right now. It's kind of a consequence of their growth. But it's still something to monitor closely.
It really is a complex picture then. You've got this powerful, integrated ecosystem, the brand, these clear competitive advantages like the bank charter, but then you weigh that against a really steep valuation and these significant economic headwinds that could definitely impact their main lending engine.
That's the core tension exactly. The bull case is strong. Tangible advantages the charter, Galileo, the FSPL driving efficient growth. 7 straight quarters of GAAP profit just shows the model works. There's a long runway ahead. But the bear case is just as valid. That high valuation leaves zero room for error. The lending business is vulnerable to a downturn, and tariffs could make things tougher. And that insider selling pattern adds a layer of caution. It's probably telling that the average analyst's 12-month price target is around $20.65. That was below the late August price of $26.15. It really underscores the speculative element at these levels. Hashtag outro.
We certainly covered a lot of ground in this deep dive on SoFi. Think about everything, their ambitious one-stop shop plan, the integrated tech, the crypto bet, but also that really high valuation. What do you think is the most critical strength they need to lean on for long-term success? Is it that low-cost funding from the bank charter, the proprietary tech platform with Galileo, or is it that self-feeding FSPL loop? Especially when you factor in those macroeconomic challenges we discussed. Which one absolutely has to deliver if SoFi is going to truly grow into the high expectations the market has set for it? Definitely something to mull over as you consider SoFi's future.